Hi, my name is Roque. I'm the president and CEO of Cassiar Gold. Cassiar Gold is a Canadian gold explorer. We have a 1.4 million ounce resource at 1.14 grams per ton right at surface that is growing not only that Taurus Deposit, but other targets around our district scale project. We have mine permits, infrastructure already in place, social license to operate, a great team. And we get all this for a 35 million market cap as we speak today.
Marco, good to see you again. Been a while. I wanted to catch up before the end of the year for everyone's kind of disappears off to do their family stuff in this holiday period. Talk to me about the last 3 years. We've talked on multiple occasions, talked to other members of your team as well. I was very clear then about what the plan was. How have things changed?
Well, first, hi Matt, and thanks for having me here, and hi everyone that is listening. 3 years ago, I joined this company in June 2020 after a review from Doug Kerwin that compared this asset to Fosterville, and he said that he saw the potential in this project for 3 to 5 million ounces. That he really liked the high grade that we have at Cassiar South, and on the back of that, we've drilled 5,000 meters in 2020. We drilled 11,000 meters in 2021. We then, in early 2022, did a resource update. We increased the resource on the back of those, 16,000 meters of drilling to 1.4, from 1 million to 1.4 million ounce resource. And then since that resource update, we drilled 23,000 meters in 2022. And then this year we drilled 16,000 meters. For which we actually still have pending to release exactly 21 drill holes, roughly 7,600 meters of drilling. So that's been coming in the near future there.
Okay, I know what you've done because I've read the press releases. I'm more interested in the why you're doing it and sort of towards what end in terms of what's the plan, not what's the strategy, but what's the plan. What are you trying to be? Because it's been a really tough market for gold companies the last 3 years. You're not exempt from that. Your profile looks like a lot of companies. Well, maybe I'll tell you a favor, it's slightly better than most, but it's downward trend. You've got to have a plan. Say, look, we got to stay relevant. We've got to stay at the table to play the game. We've got to advance the project. You've been raising money, just shy of $12 million this year. To what end? What's the plan?
Well, the plan is to eventually sell the company for a very attractive number, as they call it these days, to Great Barrett. So our goal is really to exit this through M&A. So we're growing the company, growing the project to a point where we can, try to maximize the value we can get out of that. I personally think that, I would like to see a number that starts with a B, but we're very far away from that, but we know the potential of what we have.
Right. Yeah. But let's go there. Okay. You want a number of the B. That means you feel like you're going to be in this game for a long time, and therefore that's a lot more money to be raised. So let's talk about where you're at today. 35 million market cap-ish. You've raised 12 of that this year. How quickly are you burning through that? What's your burn rate?
So it really depends on how big the drilling program is, but for this year, we've burned through roughly just under 10 million. So it's,
where's it going then? Because
the amount of drilling.
Because you've got the drilling. You said 5,000 meters drilling, right? But you've kind of got the permitted mill. You got some tailings.
16,000.
You got a large land package.
Yeah.
Yeah. So tell me about where the money's going and why is that the best place for the money to go? Some of it, I guess, you're obliged to spend, and others, I guess, you've got to define how you spend it, right?
Yeah. Most of the drilling is going towards drilling. We've drilled over 55,000 meters in the last 3 years, roughly just under 40,000 since the last resource update. So I was telling you in the beginning, on the back of 16,000 meters, we increased our resource from 1 to 1.4 million ounces. And since that last resource update, we drilled just under 40,000 meters in 117 drill holes, and we still have those 21 pending, as I mentioned before. But out of those 117 so far, we only missed 2 drill holes insignificant widths above cutoff grade, which is 0.5, which is, relatively high cutoff grade, especially for the Taurus deposit, which is right at surface.
Right, but given this orogenic nature of it, it's very kind of homogeneous, low-grade stuff, you'd expect to be hitting regularly. Maybe I'm oversimplifying here, but I want to come back to how you decide in a market like this where people are finding it hard to raise capital. I say raised just under 12 yourselves this year, so that's good going. But most people are struggling to raise money. It's expensive money when they do raise it. So therefore, you've got to be mindful of the best return on that capital invested. So again, just talk to me about the maybe targeting for the drilling. And again, is it to the end up we are going to increase the resource, and that should be a catalyst for it? Is that it?
That's the goal. Absolutely.
And what's the number thing you need to hit, though?
The number I like to hit is getting over 5 million ounces, which is what the biggest majors are. Basically, the corporate minimum they're looking for 500,000 ounces a year, 10 years, getting to 5 million ounces. That's what I would like to hit.
Yeah, that's eventually. What about NAS? With the next resource? Are you not going to put out a resource until you think that you can come back with a number like that, or is it a case of continue to raise money to continue to drill to hit a 2 million ounce updated resource, a 3 million? I mean, because the market's changed a little bit. 1 million used to be enough, right? You got 1.4, so that's good. But 2 million seems to be the new number. I suspect it's only going to grow from there in terms of companies which are interesting to strategics or majors and their balance sheets, etc. So you've got to have a sort of sense of how you play the market. And if you want to be, you've got to have a clue about what you need to present to the market. So how do you go about getting from where you are now to wherever you think it is that you need to be?
Through drilling and continue to basically step out and grow the resource at the margins, as well as potentially define new targets. We discussed the Taurus deposit that now is at 1.4 million ounces. Well, this is an early 2022 resource. We've drilled just under 40,000 meters. We've been stepping out and hitting consistently. We haven't found the edges of that system. We don't know how big Taurus is going to get. We know that it's likely to get bigger, and we're liking what we see. But eventually, we'll start, tapping out in terms of exploration potential, both laterally as well as at depth. And to your question on, how do we manage that dichotomy in terms of capital is expensive, how we target, it's really finding the right balance. The financing that we just closed, we just closed a insider-led financing recently. It is really trying to strike that balance. We didn't want to raise $10 million to have a crazy, at this current market cap, which in my opinion makes the company extremely undervalued. We didn't want to raise and dilute raise $10 million to dilute the company, just so we have a program that we believe the project deserves. So with this 2 million, we're fully funded for a significant program next year. We're going to focus on mapping and sampling and potentially geophysics, and up to 5,000 meter program, or we can focus on some of the priority regional targets, which is something that has a potential to find and prove another Taurus deposit, because we have a massive land package. We have 59,000 hectares. Taurus just currently occupies 1 square kilometer, 1 kilometer by 1 kilometer. We are obviously have been stepping out from that small postage stamp, but really, we haven't. We've done, for example, this year in 2023, the first mapping exercise, which is an area, 30 square kilometer area around the Taurus deposit, and to really start to fundamentally understand what's the true potential of our district. And what that means is that we've done that assessment in September. We don't have any results yet for that. That's still pending. But that means that 95% of our land package hasn't been properly evaluated. We're starting to, although we already have a 1.4 million ounce resource, we're only starting to scratch the surface on our project. We know there's some very attractive areas because although most of our project has cover, there's some areas where we have some outcrop in understanding the mineralization, both at the open pitable, both tonnage Taurus Deposit, as well as from the past producing high-grade veins underground. We have an understanding of what is the potential there. And that's why we believe it's possible to get to those, high numbers I was mentioning before. But we're really only starting to scratch the surface. The truth is the potential could be a lot higher than what the number I mentioned.
Okay. I want to talk to you about strategy, because in a market like this, lots of companies have been sort of agile and nimble and thought, well, if this strategy isn't working, we need to come up with something which is going to be valued in a way that it's not being in the market. Now, and some of what I'm about to say relates to sort of higher grade stories, but you're starting with slight advantage. You've got the mill, you've got ore at surface, you've got that on your side. Those are positives, I think, right? Obviously, you need to refurbish and the mill and kind of get that going. It's not a particularly big mill, but it might be able to kind of create some revenue for you. Now, you've obviously discussed this on numerous occasions, and you've been questioned on numerous occasions about it too. Is that completely off the table? Because when you talk to me about big land package and going out and drilling, left, right, and center, that sounds like a liability. The liability being, I've got to go and raise more money in a market like this to go and drill the heck out of these things to kind of drive that resource. But are you hanging your coat on that hook, which is, we are going to just deliver a big resource, someone will want that big resource, and then that can become their balance sheet problem, not ours? Or is there a bit of you that thinks, actually, to finance this company going forward in a non-dilutory way, we can explore maybe some early revenue generation model in the shape of getting your plant up and running again?
Yeah, no, that's a great question. And it's really, something that is very relevant for Cassiar. And that's something that makes Cassiar very unique. The traditional model for exploration companies, and, you drill, you find, we have a discovery, you find a deposit in the middle of nowhere, and then you find a way to pay for all the capex, including infrastructure, roads, power. We already have a provincial highway bisecting our property, as you mentioned. We already have 2 Mines Act permits. One Mines Act permit in and around Taurus, covering most of the Taurus deposit, which is growing. And we also have a Mines Act permit at Table Mountain, which is in the Cassiar South high-grade veins, which is a Mines Act permit that covers roughly 21 square kilometers. Now, the mill that you mentioned is a 300 ton per day mill, which is in relatively good shape. It's 300 ton per day. So because of the size, it's only valuable for the high grade. And that's where the strategic optionality comes in. And so there's historical production from the Cassiar South area of 315,000 ounces. From 15 portals, there's 25 kilometers of underground workings there, and those vein systems are open along strike. And actually, we've been extending them very, very successfully. But for example, the main mine has produced 150,000 ounces at over 17 grams per ton. So that's very high grade. If we're putting 20 grams per ton through that mill could be spitting out 50, 60, 70,000 ounces a year. So that is the strategic optionality that we have as a company that most exploration companies don't have, because we have the permits, we have the infrastructure, we have the mill, and we have drilled and extended these high-grade vein systems quite successfully, and they remain open along strike and down dip, and there's a lot of room for blind discovery around those vein systems. So there is definitely a strategic optionality to put that high grade into production ourselves. Now,
but there's got to be a will to do it. I'm asking the question though, because you're in control of what you're in control of, and we as shareholders need to understand how you're thinking about this. That option's always been there for you. But what I'm trying to get at is how does the company view its ability to survive this market, which has been brutal? I'm not gonna. We can jump into how great next year is going to be in a second, but if it's not so great, is there the ability for you to deliver on that strategy? Is there the ability for you to raise money on a near-term revenue model project basis in a market like this? I've seen it happen elsewhere with high grade stuff, not even as high as the numbers you're mentioning here, but have you got enough data? Have you got the intent at board level to do something like this if next year does not deliver on gold equities?
Yeah, I think there's certainly that potential. And I think this year, actually, what happened this year, making, the big, reduction in evaluation, from the big producers to the mid-tiers all the way to the juniors, has led us to, has pushed us to really assess that. We know that in 2010, the operator that had this project and that actually amalgamated the entire district that we control solely, wanted to restart production. And they had a budget to refurbish the mill, which they did partially, to rehab the underground workings, to add some infrastructure, acquire a fleet, working capital. And that budget was roughly around $12 million. They ran out of money. And in the last, basically, at the top of the last gold cycle, when gold price was dropping from 1800s all the way down, so they couldn't refinance. And that's why we are so lucky to have the project now, because they had a cost overrun and they fell flat on their faces. So there's a bit of a flag there, red flag, that tells us, like, we got to be careful with this strategy. So, going into production it's no easy task. Do we have the potential? Yes. Do we have people interested? Absolutely. We have talked with financiers, with off-takers that would be interested in such a scenario. But we need to see more exploration upside, and also we need to do a little bit more work. We've sent our engineers to the underground and checked the underground workings. We have 25 kilometers of underground workings that are in relatively good shape. Most of them self-draining, self-ventilating, and the high-grade underground and mine veins, they start at the end of those underground workings, and we've been extending those very, very successfully. We also sent our engineers, as well as we brought in a consultant to check the state of our mill, which is also in relatively good shape. So there's a bunch of de-risking activities, checking the mill, checking the underground workings. By the way, for example, at the main vein system, the underground working was driven as recently as 2010. It's relatively new, in relatively good shape, and it gets to 50 meters away from the end-line high-grade vein at the main vein system, where when we drilled for the first time, we had a 4.8 meter intercept at 35 grams per ton. That's 70 meters away from the underground working. So there's material there, but we would like to build a high-grade resource inventory before considering such a scenario, because most underground high-grade vein mining companies, they don't have that traditional model of defining 10, 15-year mine life, and then they start to mine. They have a rolling, because it's kind of hard to define these high-grade veins from surface or even from underground. They just, they produce, they drill, they produce, they drill, they produce, they drill. They have a rolling 3-year mine life that keeps on getting pushed forward. So I would like to see, I prefer not to be a hero and try to put 60,000 ounces in production just to demonstrate we can cash flow and limit dilution, when there's a much bigger price to be had by maybe selling this company for a much higher valuation, by building a lot more bulk tonnage ounces. Because the truth is, a major is not going to buy us for a 60,000 ounce production profile. A major is going to come for 200, 300, 500,000 ounces a year for 10 years production profile. That's what they're looking for, and they need it. And there's not a lot of projects like these in safe jurisdictions that have at the same time infrastructure as well as already permits in place, as well as a social license to operate, which is, without it, you don't have a project.
Okay, so you're obviously, you've burned through $10 million, you said, this year. So you're obviously very confident. I hope it's not wishful thinking. I hope you're confident about this strategy of setting yourself up for acquisition. But who in the market is buying, it's like, I'm going to call it lowish grade type projects like this where you are right now? We've seen a few M&A projects you referred to, obviously. Great Bear's been a few mergers, and and there's been some blowouts as well. So you've got to have a sense of who's looking for what you might be able to produce 5 million ounce, but at what margin? Because again, margins are getting squeezed. The costs still haven't come back down. Salaries are still up. Not all costs have fallen back down anywhere near where it was pre-COVID. So margins are still riding around the same. AISC numbers are up across the board. Whatever Gold's doing, the costs have kind of kept tabs of that. So what type of company, where's the money, and when will they be looking to kind of backfill their reserve type numbers? You feel to me, you're talking to me as a confident man who's very clear that the old Canadian strategy of just drill to the edge of the envelope will continue to work in a way that maybe some companies are thinking, well, perhaps it won't. So where's the confidence come from? What's the data that's driving that thought process?
Well, you look at the balance sheets of the majors, and what do they have? They have rapidly increasing, cash reserves. They have rapidly decreasing debts, but also rapidly decreasing resource and reserve profiles. And I think it's going to be coming from the mid-tiers and the majors. It's true they haven't been active in the market, which for me is mind-boggling, to be honest, because they're going to run themselves to zero ounce production. I don't know. I don't think they will. They will need to replace ounces. That's why Kinross paid almost $2 billion for Great Bear, because they need projects, and the world is getting very small for Western mining companies. They can't operate in Russia. Well, Kinross again, they had to get rid of Kupol. The Chinese are dominating more and more, and also the Russians dominating more Africa. You go to you want to go to Venezuela or to Guyana, which Venezuela now wants to invade. For me, safe mining jurisdictions are Australia, Canada, US, and you don't have a lot of projects in these safe jurisdictions. And I think they will be looking for these majors will be looking for projects in stable jurisdictions where the risk of getting these projects nationalized is low. Ideally, in places that already have infrastructure, because infrastructure is getting more and more expensive. And I think that's also been driving a lot of the hesitation in majors, because feasibility study from 2021 saying that the capex is 500 million. You probably better multiply that by 2. It's a very inflationary environment, and that makes the infrastructure we have even more valuable because it's already there. You don't have to rebuild the road. You don't have to rebuild the power lines. You don't have to rebuild the portals or the underground workings. We already have a mill. I think that's where the money is coming from the mid-tiers and the majors. It's very interesting to see what Calibre, depending on how you call it, they went for Marathon. I think that was a very smart move. They, just a few months ago, they had a big scare with the U.S. putting the country in Nicaragua in kind of the risky list. Their share price kind of went to half. Now they're very smartly diversifying into a safe jurisdiction with an asset that's basically under construction. That's great to see. I think the majors and mid-tiers should be taking notice because companies like Calibre are coming in and stealing their lunch. And I think when the M&A cycle starts, it's going to get, wild very, very quickly. And the valuations are just so cheap right now.
They are, but here's the thing, and you made a great point there, Marco, which is, there's a lot of companies, these mergers of equals going on at the moment because they're trying to de-risk projects, have multiple jurisdictions, as you say, some jurisdictions which used to be deemed reasonable are now not, it seems. Look at Mexico. These mergers of equals are where perhaps one party's got a little bit more money, but the asset's is perhaps a little bit riskier, coming together with other companies which are cash constrained, but have a decent asset. We've seen a lot of that sort of stuff. That's why I'm asking you in terms of what's the end game here? Because at $35 million, that's a hack, and the burn rate that you've just demonstrated today, you're talking about today, that's a heck of a lot more dilatory raisings to get to a point where you're going to have a major interested in you, right? Because you are going to need 5 million ounces, and you are going to demonstrate good, solid economics. I get the jurisdiction is good, it's on your side, there's lots of things on your side. There's a lot of time, a lot of money to get to that point. Isn't it better to see some of these mergers of equals or some of the smaller companies coming together to actually, ride the storm, as it were, but, maybe see that kind of 1 + 1 = 3 type scenario?
Yeah, no, I really like the model of what Caliber did with Marathon. So, at the end of the day, these kind of mergers, they're not really equals, but I think they're a good fit. So
I'm being nice.
Yeah. I think that they're a good fit, and I think it adds a lot of value for both sets of shareholders, in my opinion. And I think I would love to see more of that. We are in a very unique situation because we have the potential to bootstrap. We're not 100%. Our main strategy, and that's what we're committed for, is to grow this company, grow the resources, grow this project, and then sell it to a major. But we do have the strategic optionality to bootstrap this into production. And we don't have economic studies, but that puts us in a very unique position. And we want to further de-risk this path more and better.
It's interesting times
because because we don't want to end up like Pure Gold. We don't want to end up like these companies or like our predecessor, trying to be heroes and then fall flat on our faces. Like we know the value of what we have. If while we can, we'll go slow and steady. And the raise that we just did is exactly that. Striking the right balance. We ended up issuing 7 million shares in order to be fully funded for next year. But with the optionality of like if we can see the share price going up, and by the way we did that financing at a premium. If we could see the share price going up significantly, we could raise more capital and do a much bigger program and grow the company faster as well.
Sure, and I love the theory of that, but it hasn't happened for the last 3 years for anyone. So my question is about what if we get more of the same next year? What are the options available to you? And I think we've discussed a few of the good ones here. So talk to me a little bit about, and I'm going to sort of leap away from the company now. Okay, I'm sort of interested in your view of the market. Let's be positive and say, well, we think the market's going to be good for gold next year. So again, what do you know? You're an ex-markets guy. I mean, what are you seeing? What's giving you confidence about where gold's going next year?
Well, I think gold is doing its job. We crossed an all-time high last week. It was a bit of a weird day. It's doing its job. Like in the most aggressive rate hike cycle we've seen probably in history. Gold is still holding well. We see a massive increase in central bank buying. We see a lot of buying in the East. There's a lot of gold flowing into China, into India, and gold is holding its price even with the ETF holdings being decreasing for the last 12 months. And most of the holders of ETFs are Western investors. So. That together, for example, with the much talked about the Shanghai Gold Exchange price, which has been, for long periods of time, it has been trading at the $100 premium to LME or the COMEX. Well, and by the way, the Shanghai Gold Exchange is a physical market. So actually what you're seeing is physical gold moving to the East. So we're seeing the rising economies or the emerging or developing economies accumulating gold. The West is accumulating debt, I've never been more bullish on the gold price. I think gold is going to take off, but I think the fundamentally, just this week, I think we saw Fed pivot. 2 weeks ago. We shouldn't be talking about, it's too early to be talking about rate cuts. Now, rate cuts are part of the menu for discussion. Western governments, the U.S. government, Canadian government, UK, Europe, they can't take high rates because the debt levels are so high at the government level, at the corporate level, at the individuals level, talking about what matters the most, which is the government has probably bigger influence on monetary policy, which it shouldn't, by the way, but that's another discussion altogether. You can't be crystallized. The U.S. is $2 trillion in deficit. They're going to be paying $2 trillion just to service their debt. The U.S. debt is spiraling from 33 trillion right now. They can't keep rates at this level for too long. Otherwise, the system is going to implode on its own weight. So I think we're on the path to rate cuts. I think the economy is starting to show some cracks. And I think that's going to be, unfortunately, a wonderful environment for gold. And even forget about the gold price, the valuations on the equities they have decoupled from the gold price. From not only the juniors, but the big producers, they're cheap, the mid-tiers are cheap, and of course the juniors are even cheaper. It's the worst that, as most people in the space have seen this market. So I think it's going to be a good year, but we'll have to see.
Yeah, I think the US government's going to need a new credit card at this rate, because they can't keep doing this, but they do, and they will. That kind of decoupling from what gold is actually doing versus the gold equities is, I guess that's logical. Juniors are businesses that haven't really started yet. Effectively, it's the companies that are actually producing the cash which are going to get some credit, but that trickle down is a long ways away. It feels like, unless gold makes a momentous move next year. Let's hope it does. But Roque, I appreciate you making time for us. Certainly as the run up towards Christmas, I think the market slows down a bit. So thanks for continuing to work hard and sharing your strategy with us. Stay in touch next year. Let us know how you get on with your plans. And come on, gold. Let's see a comeback, right?
Yeah. No, it's I think gold's gonna do well. Thanks for having me. But even if it doesn't, we can't control the gold price. We're happy with this gold price, even if it stays like this forever. I say this sometimes. If your project doesn't work at gold 2000, you need a new project. We're happy with our projects. We're happy with the gold price, but of course, if you can get some winner sales and get the valuations. The low value, these dirt cheap valuations we're seeing, both from the producers all the way to the juniors, to get to something more normal or even better. If we can get a mania in the gold price, imagine gold price 2,500 or 3,000. Can we imagine the excitement it could create in a space like ours, which is tiny? I don't know if you ever saw that chart comparing market cap of companies like Apple or Home Depot to the entire market of the gold industry. It's a very small door, and if a lot of people try to get into it, we could all look like heroes. But I'm not worried about that. I'm worried about the things that we can control as a company. I think we have a great project. There's a lot of ways to unlock the value of what we have here. But having said that, I'm still looking forward to have a great increase in the gold price next year, and obviously in the valuation on the gold mining space.